Before I move on, let me just make sure that you see this on the slide. There's a lot of text here, but the main thing that I want to highlight for you is systematic risk is a risk that affects a large number of assets. So just what I was describing, the systematic risk that coronavirus causes the market to collapse is huge right now. And there's nothing that you can do to get away from that by buying more assets. It will affect everybody in the economy. Whereas we have unsystematic risk, which only affects a single security. So the idea would be, let's say grocery stores right now have a particularly uncorrelated risk, and therefore that is not systemic. They may move in relation to the market in general, because although people are buying right now, it may show that people in the future won't be able to buy as much. But each stock has its own unsystematic risk, which our equations are, well, they're interested in capturing, but also they will have a systematic risk component as well. So you can think of stocks as having two components, systematic and unsystematic risk, and quantifying those is important for understanding the potential return on these assets. Let's talk about CAPM. So there are a lot of assumptions about CAPM, and I haven't even really told you what the equation is yet, but let's just think about what it means to have all of these stocks and these efficient frontiers and all of these things. What we're saying is that the main thing, in my opinion, is that investors have the same expectations. We all look at a stock and we all make the same judgments about what states of the world could happen, what different ways things could turn out. We also have a perfect capital market assumption where like things just function exactly the way we think in theory, and that is a very strong assumption that we are adding to this equation and to these variables, but we kind of don't have any choice. We're also assuming risk aversion, that people would want to minimize risk. So let's say I want a 10% return on my investment. One way to do that would be to, go gambling tonight or something. Another way would be to invest it in a secure company that we expect to return 10% or more. Well, we assume that there are people that very much like to gamble, but we assume that in general, the average investor who wants a return of 10% would prefer to take the least risky version of getting that return. We have short-term portfolios, which means that every time period we rebalance our holdings, so we're just doing it from time to time. And that is a very hard thing to do because there's cost associated with it. In the real world, it doesn't really happen. People put money in Apple and forget about it for 20 years or things like that. But in general, it's an assumption that helps us make the model work. We have an assumption about rational expectations, which means that consumers are rational, or investors are rational in the way that they look at the future market and what's going to happen. And I put here because that is one of the most contested assumptions in all of finance. And, well, not all of finance, a lot of econ as well. It is something that very much simplifies the math, but is not always 100% logical. Finally, no transaction cost. Again, every time I make a trade with Ameritrade, it's at least $20 or $10 or something. And if you do that on a larger scale and look at institutional traders, all of those people have transaction costs. They may be small, but it will change the market, and there's no way to sort of pick up those pennies that are lost as a result of transaction costs being too high. The last thing I want to point out is that we need these assumptions in order to make the model work. If you don't have these assumptions, the model doesn't work at all. It is very, very difficult for people to figure out the math on these things, and so these assumptions are required. So there's a few more things. The model assumes that everybody agrees on expected returns and volatility. They agree that all investors have the same efficient frontier. So if you imagine there's only like 3 stocks in the market, every possible combination of those stocks, if all the investors observe the same information, they would all have the same efficient frontier. But not all investors have the same risk tolerance. So for our model to work, we don't have to have everybody have the same risk tolerance. We just have to have them observe the stocks and know what the potential portfolios are. They may choose completely different portfolios as a result of their risk. And so therefore, investors will hold different portfolios as a result of their risk tolerance. So I just want to point out this chart again. The green portfolios, let's say that you could only have 5 or 6 different risk categories, like 22%, that's like 20 and a quarter. If you could only have these risk tolerances, only these portfolios would be held by people because all of these would be inefficient. Let's see, is there anything else I want to tell you there? Nope. All investors have the same efficient frontier, so it doesn't matter who I am. I'm going to observe these portfolios, and I could do that, but I may have different risk tolerances, so I may choose this one or that one over the other one. So this is all of the securities from the earlier example. So let me just scroll back up and remind you. These are all the 29 stocks in the S&P. The Dow Jones Industrial Average, or 29 of them. And these are the different weights that were given. So these are the raw stocks themselves. And then if you computer generate a bunch of portfolios, like just simulate it, you get these you get all of these dots, but the red ones have the least amount of risk for the return given. And we have the same thing emerge. We have it's not quite as pretty as all the other ones, but we have, if you zoom in on them, what becomes an efficient frontier. And it looks just like the one in theory that we have right here, but it is in actuality an efficient frontier. The last part of this that I want to draw your attention to is risk-free borrowing and lending. So it's, again, a theoretical concept. So the idea is that, let me just skip to this slide. This risk-free rate that's on the y-axis that I told you is now almost 0. If we combine whatever portfolio that we have on the efficient frontier with the risk-free asset, we can achieve any of the returns that are on this line. So we can combine any of those with a long or short position on the risk-free asset. And by long, I mean we buy it. And by short, I mean we borrow it. We bet that it goes down. Any of those any of those combinations would put us on this line. And as investors that have different risk tolerances, we can do better than the old line by combining it with the risk-free asset. And let me see if I have any other. So this is called the capital market line, and you should read through all these slides and kind of learn a little bit more about it. It is one of the central tenets. This picture, like if you were to memorize this picture, it would get you pretty darn close to understanding exactly what is going on in asset pricing. If you were to really understand this and be able to talk about it on an interview at a hedge fund, they would be very interested. Now, whether or not they actually use this is another thing. A lot of funds do different types of analysis. This is just one aspect of it. The last thing that I want to draw your attention to before we move on, well, there's two things. So one is it says every portfolio on the capital market line has the same Sharpe ratio. I don't know if you remember from the lecture, but the Sharpe ratio for any asset is the expected return minus the risk-free rate divided by the standard deviation. That's the slope of this line. The standard deviation is x and the expected return is y. That is literally the equation for slope. So Sharpe ratio is the slope. The last thing that I want to draw your attention to, and this is important for the future lectures, is the expected return. This is the canonical CAPM model. And so it says there's expected return on an asset is the risk-free rate plus beta, which is something I'll talk about in a minute, times the expected return on the market, or return of the market, minus the risk-free rate. So this is how much beta down here is the covariance of a particular asset with the market divided by the variance of the market. And it measures the sensitivity of the security to the systemic risk or systematic risk. The idea being, I have a particular asset, I'm exposed to some kind of risk, and therefore this asset will have that much of a reaction to that risk. We're going to talk about this more in future lectures. I don't think that you need to worry too much about it today, but what I want you to know is that variance covariance, or variance divided by, covariance divided by variance in the form of beta is a very central concept to all of asset pricing. It is, I remember when I did Aggies on Wall Street because I was from Texas A&M and they were called Aggies, and we got to interview people on Wall Street. And one of the things that they talked about was they had this article called Alpha Hunters and Beta Grazers, and beta refers to this covariance thing. And the idea was that you wanted to get alpha and not beta. And we're not even talking about alpha here, but the idea is that when somebody mentions beta, what you want to hear, what you want to think about is that stock's reaction to systematic risk. I hope that future classes will make that more intuitive. Let me close by saying that CAPM is the best theory that we've come up with thus far. There are a lot of flaws. A lot of people have won very important prizes in finance trying to explain them. And it's not always the best model, but it is the best one that we've got. And it does a pretty good job of doing what we needed to do for the things that we need.